Hey guys, how's it going? And thanks for coming. I'm Nick and this is Real Life Money, where we talk about real life and money because you know schools aren't, so let's get started. So guys, this video is going over the 3 stocks that I'm buying for January 2018. Now 2017 was a phenomenal year in the stock market. Awesome returns. So what's 2018 gonna bring? Well, I'm going over 3 stocks that I'm looking at for the next month. So the first stock is actually more of a stable company. The second is they're starting to rebound. And the third one is all growth. And guys, just a reminder to do your own research. Just because I'm buying these stocks doesn't mean you should. So you should know what's going on with the company as well. Alright guys, so 2017 was great. However, the only problem now is finding a company cheap or fairly valued. A lot of companies out there now with this awesome year that we just had are expensive. But I did find a few good companies that we're looking at. So the first company that I'm buying for January 2018 is Corning Incorporated. Now, it's not a huge company like everyone knows about for like Apple, Verizon, etc. However, they are a supplier to these companies. So Corning's been around for like 150 years, so quite a while. So definitely have its age there. And Corning is actually one of, or the first supplier that Apple has with the glass that they use for their products. So they definitely have a long relationship with Apple. So if Apple grows with their products, Corning will as well. Now, one of the main reasons why I really like Corning is that in its company, it is diversified. It doesn't just have glass for phones, it has other things as well. So its first main source of revenue that Corning has is digital technology. So they create LCD screens on TVs. A huge chunk of their revenue comes from that. So aside the TVs, their other huge chunk of revenue is optical communication. So for example, fiber optics, and if I remember correctly, they are a supplier to Verizon. So they have some good things going for them, guys. Another small chunk of their revenue is life sciences. Still, they're dealing with glass through there. Now, the next main one is with their Gorilla Glass. Not only with Apple, but they use basically every other smartphone, tablet, and thing out there. So like Samsung uses them, HTC, LG, huge companies. So let's look at their stock real quick. We can see over here they are around or a little bit above $32 at the current moment. You can see they're around $28 billion company. All right, so you could see the chart on the side. That's their year-to-date chart. This year, they did very well. They did outperform the market, so that's a good thing. Now you can see their PE ratio. A lot of people look at PE ratios. They say a fair valued stock could be maybe like 16, 17, 18, in that general area. You can see their PE is 13, so it's kind of undervalued at the moment. And a little bit further down, you can see they do have a dividend. Another great reason why I love Corning for the long term. Just under a 2% dividend yield. Now, real quick, aside from their glass and technology like TVs, smartphones, tablets, and stuff like that, they are also trying to get into the automobile industry. So obviously, since they're making glass for TVs of that scale, it would be pretty awesome if they could get into windshields for actually vehicles. And a slight bit more detail of Corning. You can see on the left-hand side their PE right there, like we just said, around 13.5. And their forward PE for next year is around 17. So it is fairly valued. And the 52-week change. The past year, like we saw the chart before, is over a 30% So that's the first stock that I'm looking at, guys. Definitely a stable thing just because of their suppliers, of who they're doing business with. They do have share buybacks, so that will decrease outstanding shares and could increase EPS, making the stock do even better. And they very heavily into research and development, so definitely innovative, and they change with the times. Alright, so that's the first stock that I believe is going to be stable, of course, with that dividend. Let's move on to the next stock that I'm looking at. And by the way, all these balance sheets for the stocks that I'm looking at, guys, are good balance sheets. You know, they have cash and short-term investments to cover any type of short-term debt in case anything goes wrong. They're good financially. So let's move on to the second stock that I'm buying for January 2018. Company that I talk a lot about on this channel is Disney. Now, who the hell doesn't know Disney? So I'm not going to go too much into this one, guys. Just the thing is, just because of this year, even the CEO, Bob Iger, said 2017 was kind of a reset year for Disney. We'll see their returns for this year. It was fairly flat, maybe like a few percentage up. Because they were getting hit by ESPN, but now they are trying to get into streaming. They're trying to be a competitor of Netflix, and of course that is a huge market. So of course they have the Star Wars trilogy. They're going to continue on with that. They have all their amusement parks and everything. So, and they're the first company that ever existed, kind of. They've been around for a while. So long term, I have no problems with them at all. Now, the cool thing that could be happening soon is that they are trying to buy assets from Fox. So of course they have their TV as well as streaming. So like they do want to get into streaming, be a competitor to Netflix. This could definitely help them out. So enough with the words, time for some visuals. Let's look at Disney stock. They are around 107.64, and you can see the year-to-date chart on the right. They were slammed this year, guys. They are starting to rebound, which is what I like. They are a $162 billion company, and you can see their PE ratio is just under 14. So it's kind of in the area of a fair price, and they do have a dividend of a 1.5%. A little bit more detail with Disney. We could see again their PE right there, just below 19, and their forward PE moving into next year is estimated around 16.5. So again, that fair market price, which is what I like. So now, like what I was saying before, their return, 52-week return, was only a 3.66, only a slight increase, comparing it to the S&P of almost 20%. So definitely underperformed. Now, actually, in my eyes, this is a good thing. You should be buying stocks that are low so you could later sell high, or just hold on to it so they go higher. If the stock goes up, that's kind of a way that you shouldn't buy it because it's high now. You should buy stocks when they're low. So that's why I love Disney, guys. It's a fair price. Next year and the year after, when they're going into streaming, they're going to have that growth again. So that's why I'm buying them. And they have a little bit of a dividend. So that was my rebound pick. Now let's talk about pure growth. So my personal growth stock pick for January 2018 is Visa. Yeah, the credit card company that everyone knows. Visa has been doing phenomenal. Now with Visa, of course, their revenue's increasing, their net income is increasing, all that good stuff is remaining good. Now, the reason why I like Visa as well compared to maybe other credit card companies is that they don't have credit risk. So let's say if I buy something on a credit card for $1,000, I can't afford it, so I don't pay the $1,000. That's a risk for the credit card company. Visa doesn't have that risk. No matter if you could afford it or not, when you swipe, they get a commission of that transaction. Majority of their revenue is based on transactions. And just think of it, guys. all online sales are with these credit card companies. A lot of people have Visa. If you buy something on Amazon, eBay, if you're trying to find out which place they're going to, Visa is kind of covering them all, whether they buy it from Amazon, eBay, Macy's, wherever. So visuals, Visa, they are around $114 a share at the current moment. You could see they are a $250 billion company, guys. 250 billion. You can see their PE. They're at around 40. Now that is a bit overpriced. I'm going to be getting it into in the next slide, but 40, you can't deny the fact that that is a little bit overvalued. But you can see, sorry if I missed the chart. Basically purely up this whole year. Moving on. Then we have their dividend. Small dividend, okay, at around 0.69%. Now this is where we see some interesting stuff with Visa, alright? So again, we could see their trailing PE around 40, but what's even more interesting is a forward PE of 24. That's not as hugely overpriced as the 40, especially for a growth company. Of course, growth companies, people see them as growth, so they invest in them. So a PE of 24 isn't too bad at all, and you could see their 52-week change was over 40% in 2017. Now, one risk that Visa does have is that they have a bunch of competition out there. As we could all imagine, there's not only a Visa card, there's MasterCard, Amex, Discover, there's a bunch of them. However, Visa is huge, one of the largest, so you probably shouldn't worry too much about that. And to kind of ease your mind about it, Warren Buffett is investing in Visa as well. So long term, just think of how Visa operates. There's a huge amount of people buying things on credit cards, online, anywhere. So Visa has that growth for the long term. So those are all three stocks that I'm buying for January 2018, guys. All great balance sheets. Their numbers and financials are looking great with the stable of Corning, rebounding with Disney, and growth of Visa. So if you have any questions, comments, concerns, you could leave them down below. I'd love to hear what you guys have to say. If you have any suggestions or what you're buying in the new year. And don't forget to subscribe to my channel, Real Life Money, where we talk about real life and money, because not many people are. So thank you so much for watching, and I'll see you in the next one.